Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, October 17th. The European markets are shattered by the disappointing ASML and LVMH results earlier this week. And the European investors just can't wait to hear that the European Central Bank is lowering its interest rates by 25 basis points today and is also planning to deliver more of these cuts in the coming monetary policy meetings to give support to the sputtering European economies. But first, it's yet another day of stimulus announcements in China and another round of letdowns for investors. Because Chinese authorities today announced to almost double the amount it deployed to support what is called whitelist projects. So we are talking here about a 4 trillion yuan initiative to facilitate funding thousands of public and private projects in 170 cities in China. But in vain. The announcement of today was again seen as too small and too soft to match the People's Bank of China's massive easing of late and failed to give the Chinese equities a sustainable boost. So the CSI 300 index was initially up on the news, but gains melted like snow under the sun. The index is flat at the time I'm talking here this morning. Then the CSI's mainland real estate index is down by 4%, and the Hang Seng index also gave back its earlier gains. So there is still this real disconnect between the Chinese authorities and investors, and the only way to bring these two groups together to an agreement is an announcement of a massive fiscal spending figure from the Chinese authorities that Xi Jinping's government hasn't willing to do so far. So the sell-off will probably continue in the Chinese equities on that disappointment. And copper and iron ore futures are also down this morning. And the Aussie dollar, though better bid this morning after yesterday's sell-off below the 100-day moving average, sees resistance near this level. Crude oil, on the other hand, remains under a selling pressure, a touch above the $70 per barrel psychological level, and that despite a surprise decline that we saw in US oil inventories last week, according to the latest API release. Now, the China's inability to cheer the investors up and the fading worries or the relief that Israel will not attack the Iranian oil facilities, combined with a deteriorating demand outlook, will suggest that it is not a matter of if, but it is mostly a matter of when and by how much US crude will sink below the $70 per barrel level. And the bearish oil outlook remains supportive of a softer loonie Canadian dollar against the greenback, along with the softening price pressures in Canada. Because released yesterday, the latest CPI report in Canada revealed that inflation there is faster than expected by analysts in the month of September, and the headline figure now stands near the 1.6% mark, backing further interest rate cuts from the Bank of Canada to support the Canadian economy. On the other side of the border, in the US, the unexpected fall in New York's Empire Manufacturing Index yesterday gathered little attention from investors yesterday. The US dollar index extended its gains above its 100-day moving average as cable slipped below the 1.30 level after inflation reports in Britain came in softer than expected by analysts and below the BOE's 2% target, and boosted the BOE dose and the expectation of further interest rate cuts in Britain. So the sterling bears are now testing the major 38.2% Fibonacci retracement to the downside, so that's a few pips below the 1.30 mark, to eventually reverse the April to September positive trend in cable and send the pair into a medium-term bearish consolidation zone. And across the channel, the euro dollar took out the 200-day moving average support at yesterday's trading session and extended losses to 108.50 level ahead of today's European Central Bank decision. So the ECB meets today, and is expected to lower its interest rates by another 25 basis points as the headline inflation in the Eurozone is below the bank's 2% monetary policy target in September. And well, as you know, the Eurozone economies are struggling big time to keep their head above water. Germany, for example, once the zone's growth engine, is thought to be in a mild recession these days. Its car factories are suffering the Chinese EV competition and unfortunately will likely be heavily hit by the European tariffs on Chinese EVs that will eventually fire back on the European car makers. Its iconic VW, Volkswagen, for example, already announced factory closures earlier this year, and even ASML, which was the proxy of the AI trade in Europe, and which still is, but is not doing well these days after the company confessed that orders are looking weak into 2025 due to a delayed recovery in the chip industry concerning other than AI chips, of course, and all the European luxury brands, which are among the biggest European companies. I'm thinking of LVMH here, are heavily hit, unfortunately, by the fading Chinese and Asian spending. So LVMH erased all of its recent gains that were triggered by the Chinese stimulus optimism of late September after the earnings announcement and is back to the downtrending trend building since March this year. So, under these circumstances, the European Central Bank could safely deliver another 25 base point cut today and also hint at more interest rates to come in the coming meetings, because the only thing that could eventually hold the ECB officials back from sounding too dovish today is the sticky core and services inflation in the Eurozone. But other than that, there is not much. The ECB members will still remain at least a little bit cautious regarding that core inflation metric to make sure that the rate cuts don't happen faster than the music. But in fine, the Eurozone needs some financial relief right now, and inflation's trajectory, both in the Eurozone and away, are supportive of further monetary policy easing. But the market's reaction to ECB decision today and the post-decision pressure could actually be quite mixed, because a rate cut today, a dovish message from the European Central Bank head Christine Lagarde, and another 25 base point cut in December are already widely priced in. Therefore, how Christine Lagarde will sound at her post-decision presser will definitely define whether the euro will depreciate more against the greenback or it will not. And we could very well see a buy the rumor, sell the fact kind of reaction to today's ECB decision if Christine Lagarde highlights a few points or few risks to be cautious about regarding the softening inflation. So if the ECB does not convey a strong 100% confidence that today's interest rate cut is merely a midpoint in a series of rate reductions, the euro-dollar may eventually experience a rebound, a correction from its near oversold conditions, but any potential price rallies will likely see a solid resistance near the 109.80 level, which is the major 38.2% Fibonacci retracement on April to September rebound, and should keep the pair within the medium-term bearish consolidation zone for a further depreciation in the medium run. And paradoxically, the Stoxx 600 index of Europe is trading near an all-time high level these days, as the cyclical nature of the European stocks, boosted by lower rate prospects across the globe, have been fueling appetite for the European companies since a year now. But whether the European stock bulls will survive to what could be quite a gloomy earnings season in the Eurozone is yet to be seen. In the US, however, the earnings season is not going too bad, as Morgan Stanley also announced better than expected quarterly results yesterday and closed the March for big banks on a positive note. Then TSM, the company that actually builds Nvidia's AI chips, posted a better than expected 54% rise in its third quarter earnings today, after strong sales of Nvidia's AI chips offset a sagging mobile industry, according to the news, a piece of news that will certainly keep the Nvidia bulls in appetite today. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.